Hi, and welcome to The Comparable, the series in which each episode spotlights two companies building similar solutions in two different emerging markets. In case you're new here, I'm Kals, and I'm the co-founder and general partner at iDi Ventures, an early-stage venture capital fund investing in Pakistan and the region. Besides being an investor, I'm a die-hard fan of Arsenal Football Club, come on you Gunners, a voracious consumer of content, a mom, and a deep, deep believer in the potential of emerging markets, which is really at the heart of this podcast. We're back with season 2, woohoo! For our first episode, we're zeroing in on two fintech players that are taking their respective markets by storm. Moniepoint, which started their journey in Nigeria, and Abhi, which started in Pakistan. As a disclaimer at the top of this episode, iDi Ventures is an early investor in Abhi. Moniepoint, formerly known as TeamApt, was established in Lagos, Nigeria in 2015 by two former software engineers from Interswitch, Nigeria's legacy payment processing giant. Moniepoint first found success in launching point-of-sale terminals in 2019 across Nigeria that captured a massive market share because they were reliable when most incumbents were often plagued by network failures. In the last 11 years, Moniepoint has evolved to become one of the African continent's most important business, banking, and payments platforms, particularly for small and medium-sized businesses. In October 2024, it officially became a unicorn with their $110 million Series C round, and the company is now expanding their footprint in East Africa. Abhi has become a significant player in the MENAP region in just the last 5 years. Founded in 2021 by Omer Ansari, a former investment banker focused on emerging markets, and Ali Ladhubai, a fintech operator and entrepreneur, Abhi started as an earned wage access or EWA player in Pakistan. But that product was just the hook that led to the launch of a number of other financial products, from invoice factoring to payroll processing. They then also acquired Finca, a microfinance bank in Pakistan. They've expanded their presence to the UAE, Saudi Arabia, and now Oman. The company is now raising their Series B round of funding. Both companies built smartly for the nuances of their markets, building outwards from a hook product that resonated with their respective customer bases and then layered other products in their offering. Both companies have scaled outside their initial markets, and both have leveraged acquisitions as a strategy in interesting ways, and both are now market leaders that have raised significant capital. We'll break down that journey in this episode with Abhi's co-founder, Omer, and Moniepoint's head of M&A, Ross, giving you a deeper look in how they got there. Let's get into it. My guests today are building leading financial platforms in their respective markets. Ross Strike is head of M&A and investor relations at Moniepoint, a Nigerian fintech that has grown into one of Africa's most important business and payments platforms. Ross joined Moniepoint in 2023 from British International Investment, the development financial institution of the UK government, where he actually led their investment in Moniepoint and then jumped ship to join Moniepoint. Omer Ansari is the co-founder and CEO of Abhi, one of the leading embedded finance platforms in the MENAP region. Abhi is and aims to be the digital bank for emerging markets. We'll get into all that and more today. So, for both of you, I think it's really easy to look at both of your companies today and think this was the plan all along. And as you guys know, in reality, a startup's journey, especially in emerging markets, is never predictable. It never goes exactly as planned. So, Omer, as a caveat, I'm an early investor in Abhi with iDi Ventures. We met really early in your journey at Abhi, but you had I remember, really clear vision even back then on day zero for where you wanted Abhi to be in the future in 5 years' time. And really, I think the words you maybe used at the time was you were building this Marvel universe of financial products for emerging markets. Why did you start with earned wage access as your hook? And is the journey what you thought it would be? What are some of the biggest pivots or some of the biggest changes to that original vision?
The original starting point for us was always knowing that the endpoint, we're not anywhere near the endpoint, was to build a neobank servicing the under and unbanked, which was across SMEs, Bloomberg, Call Workers, you name it. That was a grand thesis of what we wanted to do. Now, the journey getting there, which we haven't, again, fulfilled yet, was building the building blocks along the way to be able to get to that point. I think why earned wage access at the beginning was, honestly, I didn't even learn about earned wage access until a few months before we started doing our fundraise. The reason for that was more salary advance, etc., that we were thinking about when it came to what we wanted to solve for, because that's something which was really important for us even to today, fixing a pain point that exists in the country that you were servicing, that people already do manually, and shifting that to become digital. And so earned wage access ended up being a form of something that people already do and understood. In fact, majority of bucks and up still call it salary advance when they use a product, even though it's technically an earned wage access product. But that's okay. The idea was that you get the product. I don't need to teach you about it, because that tends to be the highest cost of acquisition when it comes to these markets, is the educational aspect of credit. Now, if you can remove that away from your cost base and that people just get it, then they refer people, that allows you to just create a Trojan horse effect. So the reason for EWA at the beginning was we just understood this. This was something that people understood. It would catch on quickly. We did a small pilot, and it cost us no money, and we ended up getting good traction. We said, let's use this as our base to be able to then build other products on the back of it. So that was why the starting point was what it was at that point.
What have been the biggest pivots in the journey, in the last 5 years since launching?
So what's interesting is that, and this is something we continuously fight from a narrative standpoint, which I tell the marketing team we need to move away from. People still regard us as an EWA company. The truth of the matter is, now, I think less than, I'd say 20-30% of our revenues come from EWA. It was a starting point to build our customer base and quickly cross-sell them into other products, both on the business side as well as individual side. So I think what's been interesting through the journey has been the move and how quickly we moved away from EWA. Some other products as well. I mean, now gold-backed lending is one of our biggest products in Pakistan, for example, and growing tremendously well. And so I think for us along the way, it's been interesting to see that there have been these other product lines that have caught steam, which we didn't even think about. And some of these just are inherently, even in the UAE now, we're doing something in the stablecoin space on the B2B side for a working capital perspective. I have no idea we'd even be there when we started that business 4 or 5 months ago. But it's now become a large generating factor to our top line. So I think the interesting journey of credit is that it's deep, and there's a lot of use cases for it, and you're going to come across different product lines along the way which you didn't even anticipate could be revenue line items for you, and problem points that companies face or individuals face.
Us, Moniepoint's journey is a success story today, especially with their recently cemented unicorn status. Congrats on that. But, as you know, and you're coming at it from the lens of having once been an investor in this company and now you're on the inside, there were a number of pivots in the journey. In 2019, Moniepoint most notably transitioned from a white label back-end software provider to a direct-to-merchant fintech operator, which led the company to deploy POS terminals, point of sale terminals across Nigeria, which was ultimately successful because at a time where, things were not reliable, these POS terminals were constantly going down, Moniepoint offered reliability. And so would love to understand a little bit more from your perspective. You're not one of the original founders, but you have a really interesting lens here. Can you share a little bit more about why the company evolved in the way that it did, and what did these pivots unlock for Moniepoint's growth story and what products they offer now?
Like you said, I joined 3 years ago, so I don't take any credit for being part of the founding team. The founder started Moniepoint, or then it was TeamApt, over a decade ago. And like you said, the first 5 years were building solutions for Nigerian banks primarily. So they built a lot of the early mobile banking apps, gained their chops that way. It's one of our core values actually is technical depth. And almost the entire founding team, extended founding team, were all engineers with 5-10 years plus building really the first generation of banking products for Nigeria, and built actually a lot of the infrastructure as well. And like you say, I think when the time came for digital payments in Nigeria to start taking off around 2019, it was one of those things, right time, right place to a large degree. And they spun out and they started a company. The first few years were building a solution, what was known as agency banking. So effectively cash in, cash out agents using POS terminals to accept mainly card payments and allow customers and businesses to go between the digital world, which was really bank accounts, and the kind of offline cash world. And Moneypoint and a few other players at that time really solved the problem for the 80% of Nigerians that weren't served by the formal banks. So that was the first few years. That was kind of phase one. And then phase two was realizing that same technology infrastructure actually works just as well for what we call diversified merchants. So nowadays, 75% of our businesses are actually just, corner shops selling FMCG products, gas stations, restaurants, you name it. And about 25% are still those cash in, cash out agents or agency banking. And that's, again, the bulk of our business customers today. And then finally, the last few years has been realizing that the same stack and those customers actually need broader financial services. So in the last 2 years, we've really grown, similar to the Abhi experience, growing into credit pretty aggressively. And between banking, credit products, that's close to half of our revenue now. And very much, I think like a lot of people, fully owning that the future is really neobank led, with payments as one important piece, but not necessarily always being payments led.
Yeah, I can hear already tons of similarities to Abhi. But first, your distribution strategy early on in Abhi's journey was really more of a B2B to C distribution model. And I would love for you to explain a little bit about that approach because, that's what you used. It worked, it clicked in Pakistan. And then even when you expanded outwards, how are you able to really scale that distribution strategy? And I would love to take this as like, what lessons can other fintechs operating in emerging markets, what do you think that they can take from that experience?
It was always, there was no chance we would go directly B2C in the market, especially Pakistan we started off with, simply because one of the key aspects of any credit-led business is credit's easy to give, it's hard to get back. And so if you don't know what you're underwriting, how you're going to get that money back, you can build a fantastic business. And there were a few BNPL players, for example, early days when we launched in Pakistan as well, that are no longer heard of simply because of that. And so for us, B2B2C was the only way we could build this business at scale and be able to make sure that our credit portfolio as well doesn't just blow out. So B2B2C did a few things for us. One, and I'll go with positives and negatives. The positives are that it allows you to have a very small, nimble team internally. Like there's myself and Ali who were doing the sales at the beginning. Like we were sales-led founders. You had to be that. So when you're going in and you're bringing on large customers, some of our early customers like Surti, for example, 35,000 employees. Fantastic. So the cost of one salesperson went in and was able to get access to 35,000 people. Now, if you have a good product, you have a good activation rate, which we knew we had, you're then say, even if you have a 50% activation rate, happy days. You've got just under 20,000 odd people who are going to be actively be using your product for the cost of one salesperson. So one, the cost aspect of it. Super cheap, fantastic. That's really good. Two, I'd say reputation. So when you, the kind of domino effect that happens when you go B2B2C and institutions back you for the product, other people in the market tend to find out. And so then automatically your sales funnel starts increasing dramatically as well. Then the big thing for us, for example, is we have a smaller sales team today than we had before our Series A, and we have a longer pipeline of customers. And that's simply because of just brand awareness, legitimacy, big customers, etc. Third is, I'd say, in terms of your infrastructure. So everyone talks about, what's your moat as a business, etc. In a lot of these countries, the infrastructure you're providing to be able to provide your product when you're doing B2B2C is not as straightforward as an open API. So in the US, etc., I was like, oh yeah, I just linked to my API. I remember some of the companies we went to at the beginning, and even now, they'll have tens of thousands of employees, and they didn't even have an HRMS system. There was no infrastructure for you to say, let's plug our API into. So you are the infrastructure provider into that, hence the embedded aspect of this. So it allows you to be very sticky into the business. And the last aspect of it for us was the cross-sell capability. Once you're in and you're point of contact is CFO and HR. CFO tends to be the decision maker and has a plethora of products or pain points that they have that are operating in emerging markets, and specifically like Pakistan where we operate, that you come in with other products, they're happy to take it on. So those are the positives. The negatives are it's a long sales cycle. So you, unlike B2C, which is sexy and quick, and oh yeah, I got this many thousands of users in one day, etc. Blah, blah, blah. It looks fantastic on paper. You've got that kind of hockey stick, and that's what people kind of love to see, especially from a marketing perspective. But with B2B, you have to be patient. Enterprise sales can take up to 9 months. So it takes time to be able to close those aspects, and you have to be very patient and therefore be very diligent in terms of your capital usage while you're building that business during that period, so that you aren't overspending and the revenues don't kick in.
Did you find that your approach or even just that cycle shifted at all when you guys scaled to, when Abhi entered the UAE market, when you guys were entering Saudi, Oman, like, did you find that to be different, and did you shift that strategy at all?
Yes. So based on fear of God is where we change strategy. So in a place like Pakistan, moral hazard is very high, meaning that if you take out a loan, and the average person knows this, if I take out a loan and I default on it, there's nothing you really can do about it as an institution, a lending institution. Yeah, we can go to court. You'll spend 10 years in court. For a microloan, typically for the size that we provide, they know it's not worth our time. So there we have to be very diligent about how we underwrite that customer, where we're getting that salary information from, when they're getting paid, blah, blah, blah. That's very important so we can control the risk of the business. Places like UAE, Saudi, and now in Oman, for example, and Oman, really interesting. So Oman is actually the first place where we're going to be going directly B2C. Why? Because the rules are so strict. For example, if you're driving to the airport to leave out of the country, you get a speeding ticket, you will not be able to fly out the country. So there's if you on your direct debit, so you have a credit card, for example, there's a direct debit instruction at the end of the month. If you bounce that direct debit, then that is a criminal offense. It's a massive fine, and there's a bunch of penalties that put. So point being that when there is a fear of God in people and countries that we operate in, those are the places where we change our strategy slightly. We can still control the portfolio risk, but also still grow the portfolio up. So that's where we're slightly different, I'd say, in the GCC, where we're happy to take on what seemingly seems like more risk by going B2C, but in actuality, it's not as risky as doing B2C.
Yeah. It's a little bit different, Ross, for you guys at Moniepoint, because your point of sales terminals became a key differentiator in the market because they worked, which was like baseline, but that is actually what happened. But that distribution model was, as you know, very field heavy, very operationally intense, and you have more than, 500,000 POS agents on the ground. Can you share a little bit more about how Moniepoint was able to grow with these kinds of operational complexities and why that kind of approach was important in a market like Nigeria?
Yeah, sure. And I think it's a good point where it shows different approaches can work, right? Even in a single geography. I think something we grapple with is when should we start doing B2B, and we're actually starting to look at things like salary advance, but then you get into a question of, do we have to start building that HR infrastructure for our customers? That's not really a core competency, or we thought it wasn't. So interesting to hear Abhi's experience as well. But yeah, on our side, I think early days, it was quite obvious that the only way to reach 80% of the market that wasn't being served was to go directly to them. So it was a big upfront investment. I think it's one area where actually the technology helped a lot. So people think about, the POS terminal and now the app, that's the technology. But actually there's been so much investment and so many proprietary systems built over the years for managing our sales force, like dedicated software, all the reporting systems, because a lot of it is our sales network, which you mentioned across Nigeria. There's at least one person in every community, every local government area in Nigeria. And the only way you get people to use you as a financial service company is to have trust. And the kind of secret sauce to that, especially early days, we're having people representing Moniepoint, but they were trusted locally. It's not someone flying, it's not me coming in, it's not someone from Legos coming in trying to sell someone why you should keep your money with Moniepoint or use one of our POS terminals. It's someone that especially local business owners trusted. And so, of course, for that, there was a massive scale up of mainly people. So like you said, that's a big part of our organization today. It comes with a lot of complexity. It's around 30,000 people actually that are directly contracted by us to then serve all the customers. But again, the good thing is once you have them, they start to build their own teams, and so you move up people into managerial roles. You build a whole org structure, incentive system that's hard for others to replicate. So if you ask me what's our biggest moat beyond the IP brand, some of the obvious things, I think the sales network is one of the big ones, because it would take years for someone else to come in, and we're lucky enough to have recruited, I think, some of the most natural, gifted salespeople across the country already, and they're a super important part of our growth story. Figuring out all the, you need to manage those people, you need to reward them, you need to have, when things don't go right, you need to have all the right actions. So it's still a work in progress as well.
Omer, I'm going to pivot for us to talk about your acquisition of Finca, because so much of kind of taking this legacy bank where things have been offline, where things have been a little bit more traditional. That acquisition happened in January 2025, so last year, and now Finca Microfinance Bank that you guys acquired is now known as Abhi Bank. I think like acquisitions are really interesting as a strategy in emerging markets. Can you share a little bit more about how and why this particular acquisition was important in your long-term strategy? And how are you turning this microfinance bank, which was really more of a traditional microfinance institution before, how is it being turned into this neobank for the future?
Absolutely. I think your first question when we started was how the journey has been different compared to what you set out to be. I would never have. The end state goal in each of our markets is to have some form of a banking license. I would never have imagined that it happened within the first 4 years of our journey in Pakistan. So I think that's something which was very surprising and still is surprising for me to this day. But why we did it, how we did it, let's start with the why. I think one thing which is also important in emerging markets is that opportunistic acquisitions or businesses come along the way while you're operating something else. And you have to jump those opportunities when they come your way. So for us, it was a couple things that led us to the decision. One was we had an NBFC license already, a non-banking financial license, which allowed us to be able to do lending in the country, but not take deposits. The next step for us was always to get our own deposit-taking license, because that's how you get the closest to your supply. So you want to be have your deposits and bring your funding costs as low as possible for you to be able to start building the rest of your products, as well as bring your margin up. Now, that was a clear direction for us. And the second aspect of why was we became and still are the second largest NBFC in the country within about 3 years of us launching. And the first largest actually was not even a lending institution, it was a leasing institution, very different from our core business. So we effectively were the largest NBFC in the country and larger than some of the smaller banks in the country. So because there were two different regulators as well, and still are two different regulators, there became a little bit of a push from the main regulators, State Bank Pakistan, being like, well, I think it's time for us to have a conversation because you can't be growing this rate. You already become systemic in a sense. It's important for you to come in and kind of graduate up. So it was an element of, one, helping us from a cost perspective and improving our margins and being able to scale faster. But the second aspect of it also was it was becoming a regulatory risk for us to be able to do it. Now, the third of when and how it happened was that we were lucky, again, that one large institution, Finca, was looking to actually leave the country. So we got shown a few assets that we thought could be interesting for us to take on. And this was the one that we thought was the cleanest. It allowed us to have a lot of leeway with the central bank as well. That gave us a lot of support and concessions to be able to look at the asset and take on the asset. And the cap table on their side also was fantastic. I mean, you had IFCs, etc. on there. So there wasn't an element of superfluous risk that we didn't want, for example. And so that allowed us to say, okay, need to do this like the asset. Now, to your point on the third area of this is, okay, this is a legacy asset. We're a digital first entity. This has 113 branches, looks and feels like a traditional bank. I think this is where actually the narrative is important to shift from an investor standpoint for when it comes to emerging markets. I do not believe a digital only solution works in these markets, whether it be Nigeria, Pakistan, Indonesia. It just does not work. Why? Because you do not have the levels of penetration and education levels yet for a digital first solution to be there to be able to scale your business. As Ross said, the offline payments business was way more interesting and lucrative than the online basis because e-commerce penetration is much lower. Until it gets there, you got to play the hand that you were dealt and not the one you think is going to come 5 hands from now. So at this point in time, we said, look, we know that omni-channel works. If you look at any successful digital bank at scale in other markets, like Kaspi, for example, in Kazakhstan, they have a physical network of branches. So we knew that we want to have a physical network of branches to be able to continue growing the business, but we can bring in operational excellence from a digital perspective. What does that mean? That means that everything from loan processing to underwriting to disbursement to where the person gets the cash can be digitized. So what that does, it allows you to bring the cost income ratio for a traditional bank, which is typically around 65%. We brought that down all the way down to like 35%, for example. Now we want to get that down to 20%. So our focus in terms of digitization going forward, and what it has been already, has been saying, let's look internally and digitize existing processes to look and feel like a digital stack. The next stage of that is then saying, okay, now that we have this customer base, how do we make them more digitally native and provide them with more lending products on our app or whatever it may be? So that's kind of the focus going forward, to be a kind of omni-channel digital bank.
Very cool. And how does, just as a quick follow-up to that, right? I noticed on your LinkedIn, Abhi's description kind of keeps morphing a little bit, I think, as like things happen. And I was noticing that, Abhi is, your vision is to be the digital bank for emerging markets. Has this acquisition in Pakistan, how has that informed what you guys plan to do in other markets?
So the playbook has become so much more clear now because of, again, luckily the success we've had with this acquisition of a traditional asset and digitization to then play the arbitrage of what the business could be. And so what we're doing now in other markets is doing the exact same thing. So we are in the midst of looking at another asset, for example, actually 2 assets that have traditional licenses, traditional brick and mortar, but you can buy that, for example, at less than tangible book value, but you come in with a digitization approach and you can actually increase the value of that underlying asset. So what it allows it to do is it unlocks value for existing shareholders in a business that's most likely a dying business, and allows you as coming in a very cost-effective manner. This is something that's really interesting across all these markets. Even in Pakistan, for example, digital banking license a few years ago came out. We said no to it. Why? $50 million, and none of them are live yet, right? So you would go on and spend $50 million on a digital banking license to be a digital bank, but yet you have no product and you have no business. We went the other way and we spent less than $1 million, and we're a digital bank in the country, right? So my point is that this is the playbook, I think, in emerging markets. Don't get fooled as an operator by all the narratives of what you need to have to be a digital bank. If you're a digital first solution fintech operator, you're already a digital bank without the different licenses that you need. So figure out a way that you can look and feel like a digital bank without actually having to spend that much money just to fit what people think a digital bank is.
Yeah, or to be the buzzword. Ross, I'm noticing tons of nodding on your side. I'm sure there's a lot of things that are relevant for the Moniepoint experience. And, you mentioned that you joined in 2023 as their head, as Moniepoint's head of M&A and investor relations. Would love to hear a little bit about, some of the key acquisitions on your side. Moniepoint leveraged key acquisitions in order to enter the East African market in 2025 and 2026. You bought 78% stake in Sumac Microfinance Bank and 100% of Kopo in Kenya. And so curious because, obviously Nigeria is such a unique place, even within West Africa. East Africa is a totally different beast. After building in Nigeria for so long, why was now the time to enter Kenya, and why via these acquisitions? And what was important for you guys to keep in mind as you looked at strategic players in East Africa?
It's been a journey on M&A for sure. I can say it personally. This is one I've been close to the last 3 years. We've gone on a similar journey overall to Abhi, where in any market we go into now, the first question is, can we take deposits and on what conditions, under what license? And then we go from there, with the end goal being neobank serving XYZ customers. So that's been a journey, I think, over the last few years, and we've had successes and we've had some failures along the way. Kenya was always one of the top choices just because it's one of the few big countries in sub-Saharan Africa, economically pretty similar to Nigeria. So we've looked a lot at North Africa, which is South Africa. There's pros and cons, but we kind of lean into what countries are the most similar culturally and economically, and that's where Kenya stood out. Of course, it has very different payment rails for anyone who's looked at Africa. One of the big challenges is actually the kind of payments across the continent are totally different. Nigeria is more similar to Europe, really, than it is to Kenya in terms of structure, but our platform is intended and we're building it to be payment channel agnostic. So in Kenya, maybe card isn't as prevalent, maybe the relevance of a POS terminal is not as needed, but our same software, same solution can be used to accept mobile money as well. So that's kind of the future that we're building towards, and that's why Kenya. In terms of the type of deals we're looking for, again, very much like Omer said, looking at kind of traditional assets. So in Kenya, we're lucky to have acquired a microfinance institution there, and a new market is kind of looking to start with similar capabilities as part of our core playbook. I think for M&A, one of our key lessons is to be very clear what you are buying. Especially in emerging markets, usually you're not going to find that perfect off-the-shelf company at a valuation you like. So we just try to be very clear-eyed. Are we buying a license? Are we buying a team? Are we buying a business? That third one is the hardest one. So in instances where we found a team and a license and we can make the economics work, that's definitely the kind of bread and butter of our M&A strategy.
I want to dig into that a little bit more, Ross, with you first, right? I think we've seen M&A work, or is basically a tool in emerging markets. In Pakistan, it's often when there's capital scarcity, consolidation works in terms of how you can build growth. It's a great way to enter a market, to your point of how you guys entered Kenya, because there's already a license in play, and this works in regulated industries like fintech. In both of your experiences, and Ross, if you want to go first, how should M&A be leveraged in emerging markets based off of your experiences? When does it work? And what are the factors or telltale signs that then when it's not working that others can learn from? Because I know, Omer, you've experienced the other side of it too. So I'd love to hear from both of you on that.
Sure. I'll keep it brief because I think the easy way to think about it is, are you very clear on what you're solving for from a business perspective? And you have a roadmap from what you're buying to where you want to be in terms of, we have 5 core products as part of our digital financial suite. And can I map out how the M&A gets us 1 or 2 steps there? I think the way not to do it is to go from like a top-down, what works for the narrative perspective. Is this a country that investors value? I mean, there's an element you should consider. Diversification has its merits, and we do want to be Pan-African. But I think if you're not 100% sure on is it the right license? Are these the right people? Obviously, you should always hopefully know that. And then is this like scale that we want? I think one thing that I've found people rush into, including when I was an investor, is that like people just see a big business with this much revenue. Sometimes a lot of revenue already is bad. We want one tech stack. We want one business model globally. So a great business with a lot of scale might actually not be that much of a positive for us because we're going to have to rehaul a lot of it. It's going to be more work. Sometimes something smaller, but that we can accelerate and really grow as part of our technology, which is what we bring, like Omer said, alongside maybe a traditional platform that does the simple banking things right. That's a better fit than merging two really high profile fintechs with totally different cultures. So I think, again, it sounds a bit obvious, but it's just making sure you know what you're buying
Yeah,
and that
it
it
sounds
fits within
obvious, and
your.
yet I've seen players get into things
We've done
still.
it wrong. So
Yeah.
I'll be the first one to say it's sometimes you have to learn things the hard way, but
Hmm.
it's worth taking the time to go through properly.
Yeah. Omer, what about for you?
Yeah, look, I think, and Ross is much smarter than I am in this domain, but I think it's the statistic is something like 60 or 70% of M&A is failed. Historically, so it's not easy. And I think that the biggest aspect, exactly what Ross said as well, was if you can find the right team and the right licenses and businesses, um, that's like 95% of the journey done. The rest of it, you can figure it out. But if you can identify rightly those two aspects, specifically team, then I think that's what's super important. I think that's where we failed. So,
I want to pivot towards kind of the last question here, because so much of what we're talking about is like, bringing more traditional things into the future. How are we, meeting people where they are? And yet fintech globally is evolving so quickly right now, especially when it comes to the proliferation of stable coins. Abhi is leveraging tokenized debt and blockchain technology. And, I'm curious for both of you, and maybe Ross, because Moneypoint may not be in this space yet, but maybe something that is very top of mind for you guys. What does the future of fintech look like in emerging markets, and how are you both evolving and your company is evolving to meet this future? What are the things that are the most interesting, most exciting for you? So maybe Ross, if you want to go first, and then Omer.
Sure, for us, I'll keep it brief. There's so much innovation happening, and I mentioned salary advance and earned wage access earlier. Nigeria is a huge crypto market, cross-border payments. There's a million exciting things. So our biggest challenge is just knowing what to focus on for a year and just being disciplined with that roadmap. And for us, it's I would say still fairly focused on core financial services. Again, we're especially business focused, so just make sure we're getting payments right, credit right. Our big focus on innovation this year is contactless payments. So we're hoping by end of year, all of our terminals will be able to accept NFC payments. And because Nigeria is adopting smartphones so quickly, and more of those phones are actually NFC enabled devices, we think next year we'll start to see a rapid shift in terms of how people pay. And just the number of things your average user can do on a phone, and that for businesses, that's managing the business. For a consumer, that's saving, stock trading, all the interest, all wealth generating activities. So maybe nothing like groundbreaking there, but we just think still super early in the journey. So even some of these things that maybe aren't huge technology breakthrough, we think there's still a huge amount of business breakthrough that can be created.
Cool. Omer?
yeah, for us, it's been fruitful in the sense that regulatory wise, in the markets that we operate in, specifically UAE and Pakistan, have been really now, at least, I mean, UAE first and then Pakistan, really forthcoming when it comes to regulation around blockchain and stablecoin and cryptocurrency, digital assets as a whole. Um, I wouldn't say that it's a large part of our business today, but it's something that when these shift changes happen, we like to dabble into to see whether it's worth doubling down on. So one of the biggest pushes for us always is keeping cost of funds as low as possible. So tokenization of our loan book to be able to source capital from stablecoin and generate slightly higher yield than a stablecoin holder holds or is able to get, and also brings our costs down. That's something I was like, no brainer. Like this is essentially just going out similar to going from one bank to the other and saying, can I get cheaper debt? They say, yes, happy days, I'll take that. So the idea for us was let's test it out as a pilot, and it worked. And so that's something we're doing very kind of have a very focused strategy for the UAE. The next leg of it is going to be Pakistan. So how can we replicate that in Pakistan, given that we've been able to successfully do that in the UAE? And also because we play the remittance quite a bit, stablecoins just becomes a natural aspect of the business. So it's interesting. Some of these things happen inevitably, especially when regulation moves your way, because this is anyway what's being used. At the end of the day, what is fintech? Fintech is moving to a cheaper source of technology to be able to push funds or receive funds or borrow funds, right? So that is essentially what blockchain is supposed to do. They just said it took years before it came to a real world utilization of it, and we're there now. So I'd say for us, it's going to be a grand statement for this, is what I told the board as well. I think in the next 3 to 5 years in emerging markets, it's going to be the de facto underlying infrastructure you have to be on. And I want to make sure that we're starting now as opposed to playing catch up trade later.
Yeah, no, I think that's super exciting. Really excited for both of your futures in Moniepoint and Abhi. So wanted to say thank you both for being here today for our first episode of season 2. Thanks, guys.
That was it for our first episode of season 2. Thank you so much for listening, and thank you to Omer and to Ross for joining us. I learned so much from them. I think what was interesting was, learning for me personally, thinking through like acquisitions as a strategy in emerging markets. When does it work? When it doesn't work? Really thinking, importantly about what kind of approaches work. Is it B2B, B2B2C, B2C? There's no one size fits all for fintech, but really learning about how their different approaches and strategies worked for them for their different products, I think is really important. So lots to learn, lots to pick up. I hope you learned as much as I did, and see you for the next episode. Bye.